All opinions expressed by the program participants are their own and do not reflect those of Blue Line Futures LLC or their affiliates. The content is for informational purposes only and should not be taken as trading advice. Futures trading involves a substantial risk of loss and may not be suitable for all investors. Therefore, carefully consider whether such trading is suitable for your financial condition.
Hi, welcome to Macro Corner, presented by Blue Line Futures. I am your host, Paul Wankmuller, and this is episode 3. We have some exciting news with this podcast. It comes with a chart booklet full of amazing data. I'm excited about it. You can download it in the description of the podcast, bluelinefutures.com, as well as attached to the email sent to clients every Sunday. And if you're not a client, just reach out to info@bluelinefutures.com for a free trial. My guest today is the one and only Giannis Mindall. Welcome to the show, Giannis.
Hey, Paul. Thanks so much for having me on. I'm just as excited as you are about this chart booklet. It's really data-driven, and I think we'll do a good job at running people through what we cover in the write-up on each Sunday.
I totally agree with you. The theme of today's podcast is global central banks at the crossroads. Will increasing interest rates to fight inflation hurt the appreciation of asset prices? Are the central banks going to go tooth and nail to fight inflation, or are they going to try to support the prices of assets? Would that be fair to say, Giannis?
Yeah, so we are really having two sides here. Like you said, we have on the one hand financial assets and the price thereof, and then we have high inflation and the Fed's objective to return to the 2% average inflation target, which is one of their mandates. Another mandate that they have is maximum employment. So as long as employment stays at elevated levels that it is right now, it makes sense for them to go aggressive. That's why they went 75 basis points last time. Mm-hmm. But will that hurt financial assets? So far, the S&P is down 23.5% from its highs. The Nasdaq's down 32.8%. The Bitcoin's down, really a proxy for levered financial assets, 73.7%, and the Bloomberg Ag Bond Index is down 19.7%. So we're really curious to see how aggressive they'll get until employment is most likely starting to weaken.
Sure. Oh, that sounds good. I'm excited. So let's start off. Slide number 3. Let's dive into this. It's titled Liquidity Conditions, and it goes over M2 supply.
Exactly. So M2 supply is really a measure of liquidity induced by the Federal Reserve. So what we've seen there is that the year-on-year growth rate of M2 supply has come down from 26.9% to currently around sitting at 8%. At the same time, the Federal Reserve balance sheet as a percent of GDP has come down from 38 to 37.2%. So what are we really doing here is trying to measure the degree to which the Federal Reserve has accommodative or tight monetary policy. So the lower these numbers are, the tighter financial conditions are, the higher these numbers are, the more accommodative monetary policy is. So as we've seen these numbers really come in, it has trickled down into the price of financial assets because that incremental dollar that was really going into financial assets from liquidity induced by the Federal Reserve is reduced. And so the degree to which they're going to continue reducing those two figures, on the one hand, Federal Reserve balance sheet with the quantitative tightening and the rate hikes that are going to remove liquidity from the system. And then you also have M2 measuring the degree to which they're removing liquidity currently, and how that's going to translate into the price of financial assets is really the question.
All right. I do see here the velocity of that M2 coming off. Looks like right around was that March of 2021. That looks pretty sharp.
Yeah, so we are really coming off from extreme liquidity levels. Mm-hmm. And while a lot of people are really using liquidity, the type of liquidity conditions we've seen in 2020 on the back of COVID lockdowns, as well as most of the year of 2021, well, like you just referenced, beginning of 2021 was really when the year-on-year growth started to decelerate.
Mhm.
While a lot of people anchor on those two time periods, we really have to look back and state the obvious, which is, okay, those 2 years were really the anomaly. It
Right.
has not been the norm that liquidity conditions were this accommodative ever before. So
Mhm.
as things normalize, ultimately we expect or we really turn to risk assets and how they react to more normal conditions.
Sounds great. Sounds great. Thank you for that. Moving on, we will look at slide number 4. This is the high yield credit spread, currently trading around 590 bips. Is that right?
That's exactly right. So we ultimately use high yield credit spreads as a proxy for credit conditions. So the Fed is ultimately impacting the circulation of credit in the system. So as credit spreads widen, that means financial conditions are tighter, the circulation of credit decreases. And the reason why we're using high yield and not investment grade is because those are the companies, high yield, junk bonds, those are the assets that get hurt first. So we ultimately see Fed policy translate into wider credit spreads at a quicker rate than we would if we just looked at investment grade bonds. So as those spreads have expanded, one really interesting dynamic in the midst of it was that despite the equity sell-off, especially in the really early innings, credit
Mhm.
spreads stayed extremely contained. And right now that's changing. And we have also seen the Fed note in their May 2022 financial stability report that credit spreads widened considerably. So we know that they're paying attention, and that's
Right.
why we also pay attention.
That makes sense. I hear you. So where it's looks like 650 what was an extreme level. Again, that's going back to, it looks like the beginning of 2020-ish. Do you see us continuing to go back up there?
So it really boils down to, will the Fed continue to combat inflation at the rate that they're currently doing,
Right.
or are they going to pivot? And that's really the question leading into next month's Federal Reserve policy decision, and
Hmm.
also then Jackson Hole on the back of it. So
Hmm.
we will get increasingly more information as we go along. We will get more economic data. We will continue to see credit spreads trade at whatever they're gonna at whatever they respond in relation to the Federal Reserve policy. So it really boils down to this. What we can see is, looking at past recessions, those credit spreads would really be closer to 800 basis points. When
Okay.
it's going to happen remains an open question.
Great. Great. Thank you for that. Moving on, slide number 5. The Fed funds futures indicated yield. I think this one is pretty much a lock here. It looks like we're going to be at another 175 bips of rate hikes by week year end. And I believe, yeah, these are the futures that are traded on the CMA that indicate where the general idea of the Fed funds rate will be.
Exactly. So those, like you said, those indicate where do market participants who are active in federal funds futures, where do they expect the federal funds rate to be? Right now, we sit at 175 basis points. By year end, they price in an additional 175
Right.
basis points alongside the QT that's happening, and that's about to uh, double from current levels to about $100 billion each month starting in September, which they stated in the first announcement of QT. It's going to double after 3 months. So if it's going to happen, and how that exactly translates into the price of financial assets will again be the question. And can they really afford to tighten as much as the Fed funds indicate is really not clear at this point.
Right. Right. Okay, and this is on the next slide, number 6. This is something that's interesting. I mean, a little new to me. NFIB business outlook. If you don't mind, can you explain a little bit about what the NFIB is and what this number indicates?
Yeah, exactly. So NFIB Small Business Outlook really measures the optimism or lack thereof that businesses have in relation to the economic environment. So a low number, it's currently sitting at all-time lows at minus 54. So that
Hmm.
number indicates that business owners are extremely pessimistic about how much they're going to sell, how many employees they're going to hire, how much inventory they're going to accumulate.
Okay.
So that number is just reflective of high inflation, an expectation that the consumer will be much weaker, and
Right.
so you can look at this from various angles, really. But what it's currently saying is business owners are not optimistic.
Right. Right. And that is, do you feel that that is a leading indicator or a lagging indicator? As you know, sometimes we have seen in markets of extreme pessimism, that is sometimes a turnaround for asset prices if everybody's on one side of the boat, or maybe they're a little too pessimistic. What do you think about that?
Yeah, so ultimately, I might give a non-satisfactory answer here, which economists like to use too. It depends really, and it does because it all depends on how the macro environment will look going forward. Right now, the fact that it's at such extreme levels on the downside, I mean, we're exceeding 1970s levels here, which was
Wow.
basically extreme inflation, and people were really hurting back then. The
Mhm.
fact that we are at lower levels is really quite stunning to me. And is it going to be a leading or lagging indicator? It it again depends on the commitment that the Federal Reserve has to combating inflation, how businesses are ultimately going to react. What I would like to relate this to is really employment and the fact that businesses, the longer that negative sentiment persists, the more people will get laid off, the
Right.
more that maximum employment mandate of the Fed will be under threat. So that's really the one component that I relate this most closely to, rather than looking at it as a lagging or leading indicator.
Sure. Yeah, that's great. That is definitely something I'm going to start paying closer attention to. In addition to that number on slide number 4 of the high yield credit spread. That's some really good stuff. Number 7, we have the shipping rate indices. And this looks pretty interesting. Freightos, I believe, is the name. Is that the company that produces that number? Or
Exactly. So Freightos, they track different routes
okay.
of 40 feet containers. That is, so different routes and the rates for those containers on those different routes.
Okay, that sounds good. And this looks like, okay, so as this number comes down, what does that tell me? It looks like 20,000 was around the high, and now we're trading down around 10. Well, not trading, but the number is down around 10,000. What does that mean?
So what we've seen, of course, heading into or on the back of COVID, the stimulus, the associated supply chain bottlenecks, all of that. So what happened was that there was really a shortage of containers. So, and it's
Okay.
basic supply and demand, where the supply of containers was not enough and people were demanding a lot of durable goods in the meantime. So those prices went up. Now that not only supply chains are debottlenecking, but also durable goods comes off from the extremely elevated levels. I mean, we're at levels far above 2019 durable goods spending trends, and while services are still below 2019 trend levels. As that dynamic maybe inverts, we can't say it conclusively again, but as those two come closer to 2019 trends, that those shipping rates, that money that's being spent on the shipment of durable goods, is of course expected to come off a bit. I mean, it also depends again how a China policy is going to directly impact the debottlenecking of supply chains. But basically, what we're tracking is, okay, how high is demand for durable goods, and how does that translate into the policies that the Fed ultimately sets?
Okay, and it looks like all 3 out of 4 of these are from China to West Coast Europe and China to East Coast. So China does play a large component in this statistic, I'm assuming.
Exactly. Since most of the manufacturing hubs of what we consume in the West or in China, that's really the major point of focus here.
All right, sounds good. And for the final summary, we have slides 9, 10, and 11, European bond yields, European CDS spreads on 2 different pages based on Germany and Italy. This looks like a doozy. Let's dive in.
Yeah, so exactly. One of the things that I wanted to run through is really the recent uptick in interest as far as ECB policy goes. So we've seen multiple ECB officials, including the head of the organization, Christine Lagarde, talk about fracturing of the Eurozone. So what does that mean? It's basically that the government yields, the yields on the bonds of different governments in the Eurozone are rising. And you can see that on slide number 9, where really in the recent past, especially Italian as well as Spanish 10-year yields have really accelerated to the upside. Mm-hmm. So what does that ultimately reflect? It's because energy prices in Europe are increasing. It's because their associated business environment is getting much weaker. I mean, we're seeing things like the SUP business index has really cratered by a great extent. And those bond yields ultimately just reflective of there's tighter monetary policy expected because prices are rising, and as a result, those bond yields go up. So one way of measuring the degree to which there's stress in the system, or again, credit default swaps, the same way we look at high yield CDS spreads. So while at rising and increasingly rising levels, especially countries like Italy, we put that into historical context and ask ourselves, okay, how serious is the situation currently? Are we at financial crisis levels? Are we at levels when Greece had a lot of trouble with their own debt? The answer is, while we have seen a spike up in those CDS rates, we're nowhere near stress levels that we've seen in the past. So it will really be interesting, and it might ultimately be a reflection of the extent to which the ECB can tighten, but it remains again an open question, and we'll put that into continued historical context.
Sure, and a CDS, credit default swap, is basically somebody taking out insurance because they are afraid they might not get their money back, so they are taking out an insurance policy. Would that be correct to say?
That is exactly what it is. So people taking out insurance against government bonds in Europe.
Well, that sounds great. Hey, I think this has been a great episode. There's a couple of things I had not seen before. I encourage all of our listeners to reach out with any questions you have. We'd be happy to talk to you about it. Giannis, it's been an absolute pleasure once again. I'm looking forward to the chart book in our future episodes. And just for our listeners, again, it's in the description of the podcast, bluelinefutures.com, as well as attached to the email sent to clients every Sunday. And if you are not a client, please reach out to info@bluelinefutures.com for a free trial. I am Paul Wankmuller with Blue Line Futures. Thank you, Giannis, again for coming on to the Macro Corner presented by Blue Line Futures.
Thank you so much. It was an absolute blast, and I'm looking forward to this all over again next week.
Sounds great. See you then.
See ya.
All opinions expressed by the program participants are their own and do not reflect those of Blue Line Futures LLC or their affiliates. The content is for informational purposes only and should not be taken as trading advice. Futures trading involves a substantial risk of loss and may not be suitable for all investors. Therefore, carefully consider whether such trading is suitable for your financial condition.